Hello, and welcome to the March 2022 Economic and Market Update from Commonwealth Financial Network. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. After a very weak January, markets pulled back further in February. Markets were down across the board, with the U.S. indices dropping between 3 and 4%, while international markets did slightly better, down roughly 2 to 3%. Even fixed income continued to sag, largely on interest rate concerns, as broad indices were down about 1%. The weakness at the start of the month was a continuation of the interest rate worries from January, as the Federal Reserve continued to signal tighter monetary policy ahead. By the end of the month, though, the Fed was largely forgotten as attention shifted to the Russian invasion of Ukraine. And surprisingly, markets bounced back a bit to end the month well above the earlier lows. The reasons for the bounce seem to be twofold. First, interest rates pulled back in the U.S. on the invasion as investors moved their capital to the safest spot available, the United States. More, with worries about what the war might do to growth, the Fed was seen as likely to act more slowly in tightening monetary policy. The second reason was that the medical news continued to improve, with case growth rates dropping by about 2/3 every 2 weeks throughout the month. So while the geopolitical risks rose sharply, this was offset by lower medical and monetary risks, leaving markets somewhat less worried overall at month end than they had been at the start. Which is not to say there's nothing to worry about. The Fed does look likely to keep tightening policy as inflation remains very high, and it might well move higher. Two unavoidable expenses, food and energy, could be especially affected. For food, both Russia and Ukraine are major grain exporters, and for energy, Russia is one of the largest oil and gas exporters. Other commodities will also be affected, so overall the war will very likely keep inflation both higher and longer lived than we thought. The economic and policy risks are still real. And yet, despite all the bad news in the market pullback, there were positive signs as well. For the medical news, beyond the decline in new case growth, improvements in positive test rates and hospitalizations suggest the Omicron wave may fade as a significant economic factor within the next month or so. Similarly, while inflation remains high, there are signs that it's peaked, which may limit what the Fed actually does, as compared to what the markets fear they might do. The war in Ukraine remains a wild card, but even here there are signs things may not be as bad as they could be. The Russian advance has been slower than many expected, and Western nations have enacted a unified response to help contain the aggression, which will hopefully accelerate the end of the war. The key question going forward is whether the economy has enough momentum to keep growing through the current worries. So far, the answer looks to be yes. While geopolitical risks are up sharply, those are offset by much lower medical risks. While we've seen some damage and will likely see more, the net effect on the economy has largely at least stopped getting worse. And the same applies to the markets. So while there are real risks and concerns, the fundamentals of corporate earnings still look healthy. As long as companies are making money, the stock market has a cushion beneath it. And even as valuations adjust to higher interest rates, there are signs that rates may well remain at or below pre-pandemic levels, which will also provide a cushion going forward. That's not to say we're out of the woods, of course. COVID could make a comeback. While the war so far has not disrupted the U.S. economy, that could change. We'll likely see more volatility as more risks surface, and there are more risks out there. But as we move on from another difficult month, the bottom line is that despite the risks, the Russian invasion of Ukraine, COVID, inflation, and others, the economy is still growing, and the fundamentals for markets still remain sound. While we've seen substantial volatility and we may see more, that provides a good foundation going forward. That's it for this update. Thanks for watching. Join me in April for the next one, but until then, be sure to check my daily blog, The Independent Market Observer, for more timely comments. Stay safe, stay sane, and stay healthy. We are getting through this together.